I hope your day started with money. Today we're looking at Teleperformance, and I'll try to explain what the company is, why does it have such a big free cash flow yield, is it a massive value trap, and also could it be a good company to hedge your AI bets. So let's get straight into it by looking at the stock price chart, and it's atrocious. Since the peak it's down 84% and it really looks terrible. But this is also the reason for its high yield, because as you can see, from 2020 to around 2022, it was trading at around 4% cash flow yield, but then the stock price started falling and it fell a lot. Meanwhile, the cash flow actually stayed pretty decent. So that's why it's right now at almost 38% free cash flow yield. But is it sustainable? Well, usually it isn't if it's that high, but they have laid out financial ambitions for 2028, which I want to go through. And to make better context of this, I'm going to put the recent figures in my own boxes right here. So we can start with the growth, and they suggest they can do mid-single digits. But last quarter, they had a 1% year over year with a quarter over quarter decline. So that's pretty bad. The balance sheet, they want to have 1.2. Net debt to EBITDA, but on a trailing 12-month basis it was 2.8 for the last quarter, so not very good, but they might be able to lower that ratio by raising the EBITDA, which they want to do. They want to have 15.5 while the last quarter was 13.6. And then the most important part for me and for the whole thesis is the free cash flow. They're looking to make 3 billion cumulative net free cash flow over 2026 to 28 net of their internal AI efforts. So that means 1 billion per year from 2026, 2027 and 2028. And please keep in mind the market cap right now is 3.8 billion. So that would be, that's almost the entire market cap just over these 3 years. The last trailing 12 months they had 1.4 billion, so it actually looks possible. And the main operations for the company is what they call care, and that's just over half of their revenue. And as you see, this is a normal office, but actually it's a call center. What they do most is they have customer support agents that other companies outsource to Teleperformance. So say you'd have a problem with booking.com or Netflix or maybe your car, then you could call the customer support. And no matter in which country you are or what language you speak, it's a good chance it could be an agent operated by Teleperformance. And I actually used to work in one of these offices in Greece, so I have a little bit of experience what it's like, and it seems like a pretty decent business model. On their website, they boast serving over 170 countries and having about 100 countries with a TP Teleperformance presence, and also serving in over 300 languages and dialects. And I think this is a big selling point. Native speakers understand the people they serve, and I do agree with this. I think there are cultural differences and such that make it a really good thing to have native speakers serving your clients. And imagine you're a global company that wants to have good customer support. It's going to be really hard to get all languages represented, and that's maybe when a good time would be to outsource to Teleperformance that have the expertise to deliver such a thing. Here you can see the revenue split between different industries, and so media, entertainment and gaming, financial services, travel and hospitality, telecom. They're really big in the sort of industries where you would imagine that there's a lot of customer support needs. So especially travel and hospitality comes to mind to me. Like there's going to be a lot of calls to hotels and airlines and such. But if the business is so great, they have a lot of industries, it's a smart business model, then why is the stock in the dumpster? Well, it's mostly because these stupid clankers are much cheaper to employ than humans. And they're getting much smarter too. They speak most languages, and it's really smart to just employ one of these clankers to do the job instead of a human. They don't need overtime, they work anytime, and they don't do strikes, which have been a small problem at Teleperformance. I imagine too, like a lot of their customers are big IT companies, And these IT companies such as Google and Microsoft, they're gonna have the ability to make these clankers themselves. And I don't think they're gonna want to pay a lot of money to outsourcing firms like Teleperformance when these clankers can do the job, well, maybe not perfectly well, but good enough. And then maybe you can have like a few humans that picks up the cases that these clankers can't handle. But they are aware of this, and if we look at their website again, we can see that they have a separate site for AI-powered solutions. And I'm not gonna go too much into this as this is not a deep dive, but you can pause it and read for yourself what they have or visit their website. But I still wanna highlight the data labeling and annotation, and I think this is pretty interesting because it shows that even while we are training AI, we're gonna need humans to do some part of the work. For example, if there has been like a call with a customer, then maybe the AI can't understand tone or maybe doesn't understand some accents or some issues, then it's going to be good at least afterwards to have a human sort of label and annotate all the different like timestamps and sort of key moments in the customer call to then train the AI to better handle them in the future. And yeah, obviously this is something you need humans for, and Teleperformance is getting a piece of that cake. And also, this is from the investor presentation. I highlighted again, capture new opportunities in AI. In the first half of 2025, they said that they scaled audio, data annotation, and linguistic labeling work for a global tech company. And I have a really good guess that this could probably be Google. It gives a pretty good vote of confidence that Google wants to work with Teleperformance in such a line of work to develop their AI. Now, Teleperformance has pretty recently made a big investment and partnered with a company called Sanas that they have this understanding technology including noise cancellation and accent translation. And while they don't say it out loud, I imagine this is because if you as an English speaker call customer support and there's an Indian person answering, maybe you're for a reason or another not very happy, maybe you don't understand the accent. This Sanas software can help the Indian agent become more understandable. You can see on this on slider here, they can put this on and then probably they're gonna sound like they're from the US or the UK. And I think this is gonna probably be a pretty good opportunity for Teleperformance as well. They want to employ cheap labor, but they don't want to face the consequences for it. And as we have looked at the company and the problems a little bit, I want to return to this sheet and just again highlight they want to make 3 billion euros of cumulative net free cash flow during the years 2026 to 2028. And with a market cap of 4 billion, that just sounds insane. And yeah, these are financial ambitions, so it's probably a little bit made up, or maybe a lot. But they have made 2025 guidances in the last half-year report. And I want to highlight the EBITDA margin. They do believe they could make 15% at constant exchange rates, and they believe they can make 1 billion of free cash flow. And I think the free cash flow is pretty believable, because if you keep in mind the trailing 12 months cash flow is 1.4 billion, a 1 billion for 2025 would mean a decrease from what they previously made. And 1 billion, that's still over 25% free cash flow yield for this year, since the market cap is below 4 billion. But if we're gonna trust the management's numbers, I wanna highlight also their language that they use in the reports. And they use words like for like growth, which is obviously higher than reported growth. And then also EBITDA before non-recurring items. They have numbers excluding hyperinflation, and then they use abbreviations such as weighing mainly on LLS. And honestly, I couldn't be bothered to look that up, but in general, I think maybe it speaks some on the company, and I think it might make the company a little less trustworthy if they use a lot of these things. But I just want to show it to you, and it's up to you to interpret. But let's get into some kind of valuation, because I always want to do that on this channel. And I'm not going to use my normal valuation sheet, because I think if I'm going to use that, I'm going to be wildly wrong either to the upside or to the downside, because the guided free cash flow is so big. And they guide and estimate they could make 4 billion from 2025 to 2028. But if you want to believe that, then yeah, you should buy the stock. But if we don't believe that, which I think we should make such a scenario, then we could assume they make half of it. Let's say $500 million in 2028. They're trading at 3 times free cash flow. That will give a market cap of 3 billion. And if we assume they make 1 billion in 2025 and then $500 million for the rest of the years, and we assume that this money comes back to shareholders either through the dividends that they pay, through buybacks or acquisitions, raising the previous estimates, then we'd get back 5.5 billion. And the 45% upside in 3.5 years honestly wouldn't be a bad bet even at 11.2% CAGR. So it shows a big potential in the stock. But what if we play with the numbers? I mean, what's priced into the stock? What has to happen for you to lose money? Well, I think AI is going to have to take a big role, and let's say the free cash flow is actually just 3 billion for these years. In that case, we're going to get 1.9 billion in cash flow, and then you're going to lose 2% over these 3.5 years. So you're still almost going to break even with these numbers. But the point also of this video is not to recommend you to put all your money into Teleperformance. In fact, I'm not recommending anything at all. But my idea is that this could be a good hedge for your AI bets. Because let's say you're invested in Nvidia and Google and maybe Microsoft, and AI takes off. I mean, then these companies, their stocks are going to keep rising and you're going to earn a lot of money from it. And yeah, your position in Teleperformance, it might fall, you might lose a lot of the money you invested in it, but it's a hedge. Because imagine AI doesn't really work out and it turns out to be a little bit of a bubble. And the companies such as Nvidia and Microsoft, the stocks would probably fall quite hard with like reduced expectations. But then imagine a company like Teleperformance. Imagine if AI does not take away the revenue. Imagine if they stabilize at 1 billion in free cash flow or even higher. Then you're buying a cash cow at unprecedented yields. You'd be getting 25% or over 25% free cash flow yields, and say they pay half of that in dividends from current numbers, that would be like 13% yield on cost. So I mean, I'm considering placing a small position in this. I'll be honest, I don't have a lot of AI bets, but if I did, I would seriously look at this company as an asymmetric hedge to those bets. Keep cashing. Mostly because of these guys. The stupid clankers are taking our jobs. Well, it's mostly because these stupid clankers are taking our jobs.
Ticker jibs! They took our jobs! Yeah! Ticker jibs! They took our jobs!